In September 2008, Washington Mutual lost $16 billion in deposits in just 10 days, turning a large bank into a collapsing system almost overnight. That pace immediately signaled a loss of confidence as liquidity began draining faster than the bank could respond. WAMU had built its growth on high-risk mortgage lending, expanding aggressively into subprime and option-arm loans during the housing boom. This shift increased exposure to borrowers most vulnerable to falling home prices and rising defaults. As housing markets declined, loan performance deteriorated sharply, weakening the value of assets across the balance sheet. The impact spread quickly, reducing capital while raising concerns about the bank's stability. Credit markets tightened at the same time, limiting the bank's ability to raise funds or stabilize its position. Funding pressure intensified, leaving the institution exposed to continued withdrawals without sufficient support. Within weeks, the largest bank failure in U.S. history became unavoidable, showing how quickly trust can collapse a financial system.
In September 2008, Washington Mutual began experiencing rapid deposit withdrawals, with outflows exceeding $1 billion per day. Within 10 days, more than $16 billion left the bank, sharply reducing available liquidity and increasing pressure on operations. Depositors were reacting to growing concerns about the bank's financial condition, accelerating the pace of withdrawals. This shift quickly transformed a manageable situation into a fast-moving liquidity crisis. The bank attempted to secure emergency funding to stabilize its position, but market conditions had already tightened. Limited access to funding reduced its ability to replace lost deposits and maintain normal operations. Regulators increased monitoring as the situation deteriorated, recognizing the scale of potential impact. Washington Mutual's size, with over $300 billion in assets, meant its instability carried systemic risk. What began as early concern escalated into sustained pressure, leading directly into how this vulnerability had been built over time. During the early 2000s, Washington Mutual aggressively expanded into high-risk mortgage lending, rapidly increasing its loan portfolio to drive growth. That expansion mattered because it shifted the bank's risk profile toward borrowers with weaker credit quality and higher default probability. The bank became a leading issuer of option ARM and subprime mortgages, offering low initial payments that later reset to higher levels. That product structure mattered because it attracted volume in the short term while embedding long-term repayment risk. As housing prices continued rising, loan performance appeared stable, reinforcing confidence in the business model. That stability mattered because it masked underlying vulnerability tied to borrowers' ability to refinance or sustain higher payments. Internal incentives prioritized loan origination volume over underwriting quality, increasing exposure across the portfolio. That incentive structure mattered because it amplified risk accumulation without corresponding safeguards. By the time growth peaked, the system had already concentrated risk in segments most sensitive to a housing downturn. By 2007, U.S. housing prices began declining, directly impacting the value of Washington Mutual's mortgage portfolio. That decline mattered because falling home prices reduced borrowers' ability to refinance, increasing default risk across high-risk loans. Delinquencies rose sharply, particularly in option-arm and subprime segments where payment resets pushed borrowers into stress.
That increase mattered because it translated into growing loan losses that began eroding the bank's capital position. Securitization markets weakened, limiting the bank's ability to sell or offload risky loans to external investors. That shift mattered because it forced Washington Mutual to retain more exposure on its own balance sheet. Loss provisions increased significantly as the bank adjusted for deteriorating loan performance. That adjustment mattered because it reduced earnings and signaled deeper structural problems to the market. By the end of 2007, the system had moved from growth to deterioration, setting the stage for accelerating pressure in the following year. In early 2008, Washington Mutual reported billions in mortgage-related losses, including a quarterly loss of $3.3 billion in April, signaling severe deterioration. That loss mattered because it confirmed that loan defaults were accelerating beyond prior expectations, directly eroding capital. The bank raised $7 billion in new capital from investors, including TPG, in April 2008, to stabilize its balance sheet. That capital mattered because it temporarily restored confidence, but did not resolve the underlying asset quality problem. Credit rating agencies downgraded Washington Mutual's debt multiple times, increasing funding costs and reducing market access. That downgrade mattered because it weakened the bank's ability to refinance and maintain liquidity under stress. By mid-2008, the bank held over $180 billion in mortgage exposure, much of it tied to higher-risk loan categories. That concentration mattered because it amplified the impact of continued housing declines on the balance sheet. As losses mounted and confidence weakened, the system moved closer to a point where liquidity pressure would trigger a full-scale bank run. In September 2008, after the collapse of Lehman Brothers, confidence in financial institutions dropped sharply, intensifying pressure on Washington Mutual. That shock mattered because it triggered widespread fear among depositors, accelerating withdrawals across the banking system. Washington Mutual experienced deposit outflows of approximately $16.7 billion in just 10 days, one of the fastest bank runs in U.S. history. That pace mattered because it rapidly depleted liquidity, leaving the bank unable to sustain operations without immediate support. Attempts to secure a buyer or raise additional capital failed as market conditions deteriorated and counterparties withdrew. That failure mattered because it removed the final options for a private rescue. The bank's stock price collapsed by more than 90% over the year, reflecting a near total loss of investor confidence. That collapse mattered because equity markets effectively signaled that recovery was no longer expected. At this point, the system had crossed its point of no return, forcing regulators to prepare for immediate intervention. On September 25, 2008, the Office of Thrift Supervision seized Washington Mutual after determining it could no longer operate safely. That action mattered because it marked the largest bank failure in U.S. history, with approximately $307 billion in assets. The Federal Deposit Insurance Corporation immediately took control and arranged a sale of the bank's assets to J.P. Morgan Chase. That transaction mattered because it allowed core operations and deposits to continue without disruption to customers. J.P. Morgan acquired the banking operations for $1.9 billion, a fraction of the bank's previous valuation.
That price mattered because it reflected how quickly value can collapse when confidence disappears. Shareholders were wiped out, and unsecured creditors faced significant losses as the bank entered receivership. That outcome mattered because it demonstrated the cost of excessive risk-taking and weakened financial structure. What had been a major national bank was resolved within days, leading directly into long-term consequences and system-wide lessons.
In the aftermath, Washington Mutual's failure became a central case study in how rapid deposit outflows can collapse even large financial institutions. That lesson mattered because it highlighted liquidity risk as a critical factor separate from long-term solvency. Regulators introduced stricter capital and liquidity requirements, including stress testing under the Dodd-Frank framework. Those changes mattered because they aimed to ensure banks could withstand sudden funding shocks. The collapse exposed weaknesses in underwriting standards, particularly in high-risk mortgage products that amplified losses. That exposure mattered because it reshaped lending practices and tightened credit standards across the industry. The speed of the failure demonstrated how quickly confidence can shift in modern financial systems. That insight mattered because it reinforced the importance of transparency and trust in maintaining stability. Washington Mutual ultimately showed that once a bank run begins, the system can move from stability to failure in a matter of days.